Hi, I'm Valerie Leonard with Grinkmeyer Leonard Financial, and today we're going to talk about investing for the winding road ahead. Despite the recent pullback that we have seen, the stock market has made an astounding recovery from the March 2020 lows that we saw, and everybody is wondering what's in store for the economy and the stock market going forward. As a professional money manager who's had nearly 2 decades of experience in managing investment portfolios and retirement plans, I've been through periods of significant growth and also periods of insane market volatility. And I can tell you that the road to investing is one that requires patience, risk management, and also insight into what's really happening. And you yourself may be wondering, how can you position your investments going forward to work hard for you? So today, I want to share my thoughts with you about some key metrics that I'm watching closely so that you can better understand what's happening and gain some perspective on the outlook ahead. So let's get started. First of all, please know that our award-winning team at Grinkmeyer Leonard Financial is here for you. Whether you're looking for someone to manage your investments, or you want to know how much risk you should be taking, or whether you're on track for retirement, or maybe you just have other financial planning needs, we can help you get where you're wanting to go. So feel free to lean on our team if you need more specific advice or guidance. Now let's start by looking at the big picture. The good news is our economy is healing quite nicely, and spring is finally here, which has historically been a nice season for economic growth, and warmer weather may also mean that the virus is going to be harder to spread. So we know that stimulus checks are reaching bank accounts, and as a consumer-driven economy here in the United States, consumer spending can lead to higher profits for businesses. In February, we saw an increase in the number of jobs in some of the areas hit the hardest by the pandemic, like in the hospitality sector. We saw new jobs in restaurants, and we expect that job growth will continue as the number of COVID vaccinations increase in the next few months, hopefully. But we definitely aren't out of the woods yet. My husband broke his leg back in, I think it was 2009, and I am constantly reminded of how long it took him to actually heal. And the economy is no different. Anytime there is a shock to the system, especially one as large as the pandemic, there will be surprises and long-term consequences. And one area that's concerning is the rate at which costs are rising. So we're going to take a look at what the Fed is doing to actively stimulate our economy and what that may mean for the future. And we're also fairly certain that we're looking at the potential for higher taxes. We know that we still have geopolitical tensions between the U.S. and other countries like China, and we know that's going to continue, and it's going to be rocky potentially. So we're going to need to watch new developments closely going forward. So let's start by taking a look back at the stock market recovery. So this is a chart of the S&P 500, and it goes back 2 years. So for those of you that think this chart is a little scary to read, don't be intimidated. If you've ever heard that the stock market is sort of like a staircase, this is a perfect example of why you should always expect ups and downs when you are investing. So as great as the recovery has been, there have been periods of time where investors have questioned how good things really were. And when you invest with your emotions, in my experience, I find that people tend to make poor decisions. And so this is why when you're getting started or before you invest, or maybe now, just reevaluate what your strategy is and how much money you are comfortable losing before you get started. You want to know how much money can you stomach on the downside in order to have a chance at gaining money on the upside. So this chart just goes back 2 years, and you can see, of course, the decline that we saw in the market back in March 2020. And then, of course, the steady climb. But we've had periods of time where, we saw pullbacks. So look at, for instance, September, look at towards the end of the year, back in right before the election, we had 2 periods of pretty substantial volatility. The market moved higher, and then February and March, we've also seen some pullbacks as well as in late January. So this just kind of shows you at least what a picture representation of the stock market looks like and kind of where we've been and, the trend since the pandemic started. Now, this is a chart of the technology sector. And as you can see, it's basically traded sideways for the past month. And it's led a lot of people to question whether technology has had its run and whether it's done because it's been so overbought. So if you look back just kind of here at the far right-hand side of the chart, you'll see that period of time where the market the technology sector has traded sideways. So we've certainly seen quite a bit of speculation this past year, and this feels a lot like the dot-com bubble of the late 90s. And while only time will tell whether the rally is sustainable, I personally think that America will continue to innovate and encourage entrepreneurial ideas, which will lead to further expansion and growth. The problem with most investors today is that they tend to be so short-sighted. But I want you to think about how much the world has changed because of technology. Investors today now have access to more information and data than ever before. Just look at the GameStop and the AMC and Reddit headlines back from January. And on that note, I think the quote from Jesse Livermore, which Jesse Livermore was a pioneer day trader. He lived between the late 1800s and 1940. And he said it best when he said, "There is nothing new in Wall Street. There can't be because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." And that is still true today. So don't think that GameStop and AMC trading scenarios haven't happened before. You're just hearing about it because the mainstream media grabbed a hold of it and made it seem new. And also because it's not professional investors who are involved this time around. Now, I showed you this chart in my last video, but I wanted to remind you how much the money supply has increased over the past year. So this represents the actions taken by the Fed, the Federal Reserve, and by Congress. And so this chart shows you the total value of money available in the United States economy at various points in time. So every U.S. recession going back to 1960 is shaded here in gray. And you can see from the blue line that the money supply has slowly grown over the past 60 years until the pace started rapidly increasing after the 2008 financial crisis. But then I want you to look at the massive vertical spike in 2020 when the Federal Reserve and Congress acted swiftly in order to try to stimulate our economy and create liquidity in our financial markets. And the 3 rounds of stimulus and some of the other monetary policy tools that they've had at their disposal has created this massive spike in the money supply. And this is important because we've never seen the supply of US dollars spike to this level before at any point in our history as a country. So this has led to higher prices. Now, homeowners and those of you that may be looking to buy a home or have recently bought a home know better than anybody right now how quickly housing prices are climbing. And we expect inflation to continue to accelerate in 2021. So in case you're not aware, the price of lumber is up almost 200% since the pandemic started, and that increases the cost of home building. We're seeing lots of home builders who are holding back on construction. And I've even heard that they are building fewer homes, but still intentionally raising prices to kind of smooth out the difference. And eventually, lumber mills will be able to safely reopen and supply issues will work themselves out, but it's going to take some time. And it's not just lumber that are where we're seeing higher prices. We're seeing supply issues across the board from semiconductors to auto manufacturing, and also from plastic to corn. And this is all leading to higher prices for Americans. And this certainly can have an effect on your investment portfolios and, of course, your pocketbook. Now, the Federal Reserve is targeting a 2% inflation rate. So if you ever follow what the Fed is doing, they release meeting minutes from time to time, and they've said 2% is the target inflation rate. However, there are areas of our economy that are growing at a clip that's higher than 2%. And conservative investors need to pay attention to their bond portfolios, or that portion of their portfolio that's exposed to bonds or fixed income. And for riskier investors, historically, commodities have been a suitable hedge against inflation, but you also have to understand the risk before you go down that road. So let's take a look at energy prices. We're starting to see the effects of everybody venturing out of the quarantine and starting to demand more fuel. So this chart just basically kind of shows you the prices that we've seen recently. Now we know as the globe emerges from confinement, this trend will continue, and that has the ability to drive prices even higher. So if you'll notice on this chart, this one goes back 5 years. Energy prices hit a low back in March of last year and have since rebounded sharply. And we are currently nearing pre-pandemic levels. Now, this next chart is the chart of the day. Now, many of you know what bonds are, many of you don't, and that's okay. I'll explain more here in a minute what you need to know and how it can affect you when you're investing. But the fact of the matter remains that the bond market is the largest liquid market in the world. And so when you're investing in stocks, don't be fooled and don't think that the bond market doesn't impact you, because it does. The big money managers, the big hedge funds and institutional guys, pension managers, they're always watching the bond market. So where do investors traditionally go when they need stability for their portfolios? When they want maybe some more conservative investment options than what the stock market typically offers? That's right, they go to the bond market. So let's look at this chart closely. Now, you'll see here, this chart goes back 2 years. And this shows the aggregate bond index, which is kind of a basket of bonds here in the United States. And you can see, of course, bonds, which are, remember, traditionally conservative, sold off back in March of last year. So this is where, when we talk about events like, we call them black swan events, the 9/11, the financial crisis, the pandemic. These are all events that none of us can see coming. Everybody's kind of in the same boat together. It's very difficult to keep from losing money unless you're in cash. And, it's one of those events that, most people are going to lose money in. So bonds historically have done sort of the opposite of what the stock market has done. But back in March of last year, that didn't happen. Everybody got nervous that bonds wouldn't hold up. And of course, they did rebound sharply. That's where you see that V effect in this chart. And then they went higher through August of last year. And then since that point, they have steadily declined. And technically speaking, right now, the bond market is trending negative. And even though we've seen a little bit of a spike in late March in the bond market, as you can see to the far right of the chart, we're still very concerned about bonds in general, primarily because of inflation and some other factors that are going on in our economy. So what does this mean for you? Before I answer that question, I want to show you, this is a chart of the US dollar, and this also goes back to March of 2019. And it kind of shows you what the dollar has traded at. So you can see it spiked in March of last year at about $103.50 on the dollar. And then just recently, it is back to about 92.78 or so. But again, the dollar has also been in a downward trend since the pandemic started. Even though we've seen a little bit of spike since, kind of mid-February, we're watching the dollar very closely. And I want to just kind of give you a little bit of a glimpse into how bonds work and why it's important for you to understand them. So think of bonds sort of like a teeter-totter, okay? You have the price of bonds on one hand, and you have the yield on the other. And when the yields go up, so yields are kind of like interest rates. When yields go higher, the price of bonds fall, okay? And that's why it's important to watch interest rates. And that's why it's important to kind of always know where you are in economic cycles. So currently, we have been in an environment where interest rates have been falling for quite a while, which has driven the price of bonds higher. And then we got into the pandemic, and of course, we've started to see some dislocations a bit in the bond market. And we believe that interest rates are going to be going higher over the next few years, although not necessarily right away. I do think it'll be sooner than probably the Fed lets on. But once interest rates move higher, that's going to drive bond values down. And that's where we're concerned that more conservative investors are going to get into trouble and lose money in their portfolios. So how do you protect your investments? Well, first of all, interest rates matter, like I mentioned. So always pay attention to what's going on with interest rates. Inflation matters. Like I said, inflation is bad for longer term bonds, okay? So when you buy a bond, it's going to have a maturity date attached to it. And that maturity date could be anywhere from 3 months to a year to 5 years, 10 years, all the way out to 30 years, okay? Now, when you have a 30-year bond, it's going to have more interest rate sensitivity. And that's where you have to pay attention to what that maturity is on that bond. Duration also matters. Duration is a measurement of how sensitive your bonds are to a rise in interest rates. So as an example, if you have a bond portfolio that has a duration of 5 and you see a 1% movement up in interest rates, then that means your bond portfolio hypothetically could lose 5% of its value. So that's why it's important to pay attention to the duration of your bonds. Also pay attention to the quality of your bonds. Do you want to own high quality US Treasuries? Do you want to own corporate bonds? Do you want to own junk bonds? This is where professional money management and really doing your homework comes into play. And location matters as well. Are you trying to buy bonds based here in the United States, or are you buying international or maybe emerging market type bonds? So you need to pay attention to all of these factors when you're building a more conservative portfolio, or maybe you're just looking at that piece of your portfolio that traditionally would be invested in bonds to try to take some of the volatility out of the mix in the event that the stock market were to fall. So again, I believe in balancing your portfolio with a combination of stocks and bonds, depending on your risk level overall. If you don't know what your risk level is, let's talk about it and let's find out how much you should have in stocks and how much you should have in bonds. But overall, just know that whatever you have in bonds at the current time, you need to be really strategic with what you own. So I mentioned the unemployment kind of piece of the equation when we were looking at the big picture early on in this presentation. Right now, the employment rate is sitting, or unemployment rate rather, is sitting at 6.2%. And we believe that job growth and just kind of the future of jobs in this country are going to be dependent on the continued rollout of the vaccine. So that's something, of course, that's going to be really critical to watch. We want to see that Americans have jobs, that they have discretionary income in their budgets, and that they can go out and spend, because that's what will cause our economy to tick higher. Also watch corporate profits. Now, fourth quarter earnings were better than expected. We believe that profits may recover to pre-pandemic levels in the calendar year 2022. But right now we're watching the areas that were hit the hardest by the pandemic. So think industrials, energy, financials, hospitality, and leisure. These are all areas that we're watching closely to see how they do going forward. And also, we're looking at international stocks. We know that vaccinations are off to a slow start in the rest of the world. We know that the global economy is poised to emerge. The rest of the world hasn't had that rebound like we've had here in the United States. And in many cases, a lot of the stocks overseas have better, more attractive valuations than we do here in the United States. So the outlook for strong economic growth is positive. And because we also have a weaker US dollar right now, that can benefit foreign companies. And when you and I, as US investors, go and we invest in companies overseas and we make profits in those companies and convert those back into US dollars, that's a plus for us as investors. Now, where you are in the rest of the world is going to matter. And whether you're looking at developed economies or emerging market economies, you kind of have to pay attention to what's happening with currencies. Also, this chart looks a little hairy I like to show this because every color here represents the major asset categories that you can choose to invest in. And what you'll notice is not one color is consistently at the top. Now, large cap growth, that navy blue category, has certainly had a good run 4 out of the last 10 years or so, but it's never always at the top. And the yellow box represents a balanced portfolio. So this is somebody who's not super aggressive, not somebody that's super conservative. They're kind of in the middle, and they're taking a more moderate approach to their investments. And you'll see they're not probably going to ever be at the top when it comes to the best investment performance, but they're generally not at the bottom either. And so if you're not sure what approach is right for you, then a balanced approach might be one to consider. But just kind of know that you can see we call this kind of the quilt of investing, or the kaleidoscope of investing. The colors are kind of all over the board. So this means that you as an investor are going to have a very difficult time timing the market and trying to strategically pick which categories are going to do best going forward. This is why it's important to have a diversified approach. So if you have any questions, feel free to reach out to me. I've enjoyed my time with you today. I'm here as a resource. Like I said before, lean on our team if you need somebody to give you investment advice. If you're looking at your retirement account and you don't exactly know what to do, feel free to reach out. I'm happy to help, and I look forward to connecting with you soon.